Who writes the rules of global finance? In 2008, global financial markets collapsed, banks failed, currencies shook, entire economies came under pressure. Governments stepped in, but something unusual happened. The rules that determined how the crisis would be managed were not written in parliaments. They were written in meeting rooms in Brussels, in Washington, in London, by central bankers, regulators, economists, people most citizens had never heard of, which raises a question few people ask. Who actually writes the rules of global finance? This is episode 5 of Lessons Untold, How Modern Power Works. In previous episodes, we saw how empires collapsed under financial pressure, how the Commonwealth replaced political rule with systems, and how technocrats built global networks. But those systems required something deeper: rules. Rules that govern money, banking, capital, risk, and crisis. Because in modern power, whoever writes the rules shapes the system. Empires once governed through authority. They imposed laws directly, collected taxes, controlled trade, enforced compliance. But after empire, direct control became expensive and increasingly unnecessary, because power had discovered something more efficient: control the rules, and you control the system. You don't need to govern every country if every country operates under the same financial rules. After the Second World War, a new financial system began to emerge. At its center were institutions created in 1944 at Bretton Woods, the International Monetary Fund, the World Bank. But these institutions did not act alone. A broader architecture developed: central banks, finance ministries, international regulatory bodies. And at the center of that system sits one of the most important and least understood institutions: the Bank for International Settlements, founded in 1930. Located in Basel, often described as the central bank of central banks. If countries are the players and banks are the instruments, then institutions like the BIS write the rulebook. In Basel, central bankers meet regularly. Representatives from the Federal Reserve, the Bank of England, the European Central Bank, the Bank of Japan, and many others. They do not pass laws, they do not hold elections, but they design frameworks. The most important of these are the Basel Accords: Basel I, Basel II, Basel III. These frameworks determine how much capital banks must hold, how risk is measured, and how resilient financial systems must be. In simple terms, they define how safe or fragile the global banking system is. A decision made in Basel can change how banks lend in New York, Lagos, London, or Singapore. Modern global finance operates on standards, not commands. Standards such as capital adequacy ratios, liquidity requirements, stress testing frameworks. Countries adopt these standards voluntarily, but in reality, they are not entirely optional, because global markets reward compliance and punish deviation. If a country ignores these standards, investors lose confidence. Borrowing costs rise, capital flows elsewhere. The system enforces itself. Power no longer needs enforcement, because the market does the enforcement. The rules of global finance are not written by a single actor. They emerge from networks, central bankers, regulators, finance ministries, international organizations, and increasingly, large financial institutions, global banks, investment firms, rating agencies. These actors provide input, analysis, and pressure because they operate inside the system and understand its vulnerabilities. The people most affected by financial rules are rarely the ones who design them. Financial crises accelerate rulemaking. After the 2008 crisis, new regulations were introduced, higher capital requirements, stricter liquidity rules, enhanced supervision. The Financial Stability Board, created in 2009, began coordinating global regulatory responses, chaired initially by Mario Draghi, later president of the European Central Bank. These changes reshaped global banking, not through politics, but through coordinated technical decisions. Crises don't just expose weaknesses, they rewrite the rules. Not all countries influence rulemaking equally. Advanced economies have stronger institutions, deeper financial markets, more experienced regulators. They often shape the frameworks. Emerging economies must adapt to them. Singapore is again instructive. It did not resist global financial rules. It aligned with them, strengthened regulation, built credibility, attracted capital. Other countries struggled. Weak institutions made compliance difficult. Policy instability reduced investor confidence. The same rules produce different outcomes. The system is global, but the ability to benefit from it is not equally distributed. Today, the rules of global finance are evolving again, driven by technology, digital payments, cryptocurrencies, central bank digital currencies. Institutions are now asking, who controls digital money? Who regulates decentralized systems? Who sets standards for financial technology? Once again, the answers are not coming from a single government. They are emerging from networks, committees, central banks, international forums. The pattern continues. Empires control territory, modern power controls systems, and financial systems depend on rules. Those rules determine who gets capital, who bears risk, who survives crises, and who grows. Which means, who writes the rules shapes the world. The architects of global finance are rarely visible. They do not command armies. They do not campaign for votes. But they design the frameworks that influence billions of lives. Because in the modern world, power is not always exercised directly. It is embedded in systems and written into rules. In the next episode, when rules break, the crises reshape global power. What happens when systems fail, and who decides what comes next? Lessons Untold. Relax, review, reflect.